Okay, let's be honest. Today was a crapshoot day for markets. Okay, terrible. The shit hit the fan. The fan's been spinning for a while now. We're all starting to get a little bit dirty out here. Okay, now something interesting did happen today. You did get this sell-off in the NASDAQ, the S&P, and the Dow, whereas the Russell was actually green today, up a third of 1%, and the VIX was pretty well behaved. Again, considering the NASDAQ was down almost 1%. The VIX was up only 0.80%. Here in this video, I will explain what happened today, why I'm not concerned about this whatsoever, and why today could actually be a good thing heading into January, or at least not as bad as some people think, okay? Now, first and foremost, as I've explained here on this channel many of times before, when markets are this negative, when almost 70% of stocks are in a pretty severe downtrend, you want to be buying markets. That's first and foremost. As long as this is a bull market, last I checked, this is a bull market. Last I checked, nothing has really changed all too much in the last couple of weeks. Okay. Everyone says, the Fed, yeah, the Fed changed things. They did. Okay. We were expecting around 3 cuts next year. They came in with 2 cuts. Big deal. 1 less cut. Because why I say big deal is not because, just the amount of cuts went down by 1, but the Fed hiked their growth expectations. So the Fed's expecting faster economic growth and less cuts. Okay, fine. That kind of like net equals itself out, okay? Because you would want faster growth with less cuts in a perfect world, okay? In a perfect world, if the economy was doing just fine, like the Fed wouldn't need to be cutting rates at all. So the Fed's saying they're going to cut rates less. They're just hiking their growth forecast. Okay, as long as we are not in some kind of stagflationary environment, in which we're not. The economy is growing. Yes, we do have higher inflation, but we're not in some kind of stagflationary economy. Okay, so nothing really changed from that perspective, and that's important to point out. So when 70%, almost 70% of stocks are in an active decline and bull market's still intact, you want to be buying the crap out of that market, historically speaking, okay? This has always been a good buying opportunity during bull markets. Now, whether or not 2025 is a bull market, obviously we'll have to wait and see about that one. Now, CNN's Fear and Greed Index is coming in at 29 today, which is almost an extreme fear. Anytime you're in the bottom end of fear or extreme fear in a bull market, again, you want to be buying the crap out of markets. So you are at the buy the crap out of markets level. Again, does something change? Does something happen next year? Are the markets forecasting some kind of big change to the markets next year? I do not think so, personally. Now, the RSP is already down about 8%. This is the equal weight S&P. If you include like all stocks out there, NASDAQ, S&P, all of them, the average stock is down over 10%. Okay, now that looks a little bit different. Again, when you look at the headline S&P, it's only down about 3.3% from all-time highs. So the indexes are kind of masking a lot of the weakness under the surface. The RSP is a better example of this, but really, things are even worse off than what the RSP is showing us. Now, what is happening today? We don't have any economic data. It is the last trading day of 2024. I will be as blunt and honest with you as I possibly can to what is happening. What is happening here is you are seeing tax loss harvesting. You have already seen tax loss harvesting, a lot of it in December. That's represented with the RSP. Now, what's kind of interesting about 2024 is, yes, it was a good year for markets, but a lot of the big gains, the actual, gain of the S&P were in large cap tech. So there was a lot of stocks this year that actually fell and did not do well. And so there's a larger portion of our markets that can be tax loss harvested. And that's why I think the larger sell-off, the broader based sell-off we've seen in markets in the last couple of weeks is really tax loss harvesting, because there's a lot of areas that you can tax loss harvest instead of maybe a normal year where the S&P is up 20%. Maybe the gains could have been more broadly inclusive. In that kind of setup, you would see more tax loss harvesting in certain specific stocks. This time around, there's a lot of stocks that are being tax loss harvested. So I think that helps to explain why the RSP has sold off so much. Now, big tech is really the loser today, which is interesting. Big tech, I think, is going to be the underperformer in 2025. So what I think is happening today is hedge funds and institutions, they kind of already know that big tech is going to be the underperformer next year. So they're going out and they're taking some profits on big tech right now. Okay, they're trying to get ahead of what everyone else is going to be doing, and that is taking profits in big tech at the start of 2025. So that's why I think you're kind of seeing just a broader market sell down today. Big tech is really underperforming. Something like Nvidia is really underperforming compared to the S&P. In fact, all big tech, all Mag 7 is falling more today than the SPY. And it's falling a lot more than the RSP. The RSP is down 0.2%, 0.2%. Apple's down 1%, Meta's down almost 1%, Amazon's down 0.7%, Microsoft down 0.7%, Google's down 1%, Nvidia's down 2%. So Nvidia is falling, 10 times more today than the RSP. That is wild when you think about it like that, okay? And I think it's just some profit taking. And what we're going to see to start 2025, which is on Thursday. Markets are closed for New Year's tomorrow. But what you're going to see in 2025 and in January is probably a pretty pronounced January effect. You're going to see those tax loss harvested stocks recover. And I think you're going to see areas like AI appliers, companies that are actually creating use cases with AI actually outperform. I think you're going to see small caps outperform. Value and mid caps and cyclicals, basically everything's going to outperform big tech, I think. That's my prediction. For anyone that does not know what the January effect is, it is the supposed seasonal tendency for stocks to rise in the first month of the year. The January effect is said to occur when investors sell losing stocks in December for tax loss harvesting and purchase them for the new year. Like other market anomalies and calendar effects where sentiment and non-rational motives appear at work, the January effect is considered by some as evidence against the efficient markets hypothesis. Yeah, and markets are not that efficient. Some, certain areas are. Big tech is certainly pretty efficient. It's not a lot that goes unnoticed there. But a lot of other areas are not super efficient. That's neither here or there, though. I do think there's going to be, again, a pretty pronounced January effect. Now, as we get into January, Thursday of this week, like literally the day after tomorrow, we have initial jobless claims. And then on Friday, we have your ISM manufacturing PMIs. But that's it. We really don't have that much data for next week either. And we don't have any earnings. At least earnings season does not kick off again until January 15th with the large banks. So you really don't have much going on over the next couple of weeks heading into the inauguration. That's going to be another volatility kind of event. But between now and then, I think there's a, pretty good bull case to be had for a broadening out of our markets in January, because it doesn't really make a whole lot of sense why so many stocks are beaten down right now, why 70% of stocks are in an active decline, and the CNN Fear and Greed Index is almost in extreme fear. There's not a clear reason for that. So I think it has to do, again, a lot of tax loss harvesting, and even today, some profit taking of big tech. But I don't think the situation is nearly as bad or will be nearly as bad as what some people are saying and what some people in markets are coming to expect. Now, I'm going to play this clip for you from CNBC. This says, the bond market is getting ahead of itself with headwinds coming. Now, what this means is, as strategist here, analyst is going to tell you, is 10-year Treasury yields could actually come down a lot. If 10-year Treasury yields come down a lot in the first couple of months of 2025, that's going to be really good for small caps and AI stocks, AI appliers, that is. Semiconductors, maybe not as much. You know, small caps, mid caps, cyclicals, industrials, all of those areas are going to benefit a lot from this. And I think he makes a pretty good argument. So take a listen to this.
Joining us for that is Tom Tesouris, who is Strategas Securities Head of Fixed Income and Research. Also, he's the lead fixed income portfolio manager there. And Tom, thanks for being with us this morning. What do you think about this conundrum we've seen in rates? How, the rates have had their own mind. The Fed hasn't really had control here.
Yeah, and this has been a very bad year for the bond market. And it's been a year, in fact, where both bears and bulls have looked like they've been wrong quite a few times along the way. But we would agree fundamentally with why yields are rising at this point in time. But we just think the bond market's getting a little bit ahead of itself. In particular, there's a few headwinds to further increases in yields that are likely to hit in early 2025. And so those headwinds have to be dealt with before yields can keep creeping higher. But fundamentally, it makes sense that yields have crept higher, even as the Fed has cut, because one, the market had priced in too many rate cuts for 2024 and 2025. And two, the market was looking past, at that point in time when 10s were down to 360, the enormous supply that is going to have to come on board in the next few years as the Treasury, one, continues to finance large deficits, and two, begins to refinance the Treasury bills that the Yellen Treasury had pushed into the market over the last 2 years. So that has to be dealt with. And this is the big reason why yields are rising. But we got to get through this soft patch in the first quarter of 2025 that we think is going to hit. And we also have to get through the debt ceiling increase, which until that debt ceiling is increased, there's going to be a shortage of treasuries entering the market for at least a few months in 2025. We got to get through that too. So shorts are going to have to be very cautious about maintaining positions with yields at these levels, because there's a lot of risk that yields reverse drastically lower in the next few months.
I mean, I guess the good news is you're not talking about an inverted yield curve, at least between the 2s and the 10s anymore.
That's correct, especially with the Fed still likely to cut at least 2 more times next year, likely in March and in June. And even if they only deliver 1 more cut, you're looking at the Fed funds rate down to 3.75 to 4, and 2s around 4%. So 2s 10 spread should still be positive in 2025.
You know, the point you made about Janet Yellen and the treasuries that had been issued to this point, you're saying that that's the biggest reason for the issues right now because of the length of duration?
Well, it is as of today, but if you assume that we're going to be running trillion-dollar plus deficits beyond 2025, then eventually, cumulatively, that will overwhelm the T-bill issuance. But we've estimated that between, we'll say, 2022 and end of 2024, the Treasury pumped about $2 trillion of excess T-bills into the market. Those are going to have to gradually be scooped and tossed out to the 5 to 10-year portion of the curve majority, and that is probably a bigger concern for the market right now than deficit next year. The deficit next year should actually come down materially versus 2024. So it's scooping and tossing those bills that's a bigger concern at this point in time.
Big question, though, is what happens with inflation? Is it stickier than had been anticipated? And what about the economy? How does it hang in there? What's your answer on those two fronts?
Well, I think they're going to be working against each other for much of next year. And what we mean by that is that inflation is probably going to be coming down for a little bit next year into, we'll say, end of first quarter. We think inflation is going to trickle a little bit lower, and then it's going to get sticky again around a 2.25 to 2.5. We're kind of there right now. And then during that period, you're also going to see, we believe, a soft patch in the U.S. economy, driven in large part, I think CNBC has written about this recently, credit card debt. It continues to be a drag on the consumer, and that drag hits hardest in the first quarter. So we think there's going to be a soft patch next year. But then, if you assume the economy reaccelerates, inflation is probably going to be going with it higher. So you're probably going to see in the second half of the year, you're going to see inflation trickling back towards 3%. And by the end of of next year, it might be above 3% again.
That said, ladies and gentlemen, let me know what you think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in 2025, which is tomorrow.